Welcome back, accounting students. This is Mrs. Bloomquist. We are moving on into Chapter 10, and Chapter 10 deals with accounting for sales and some cash receipt information. So, learning objectives as we get into the first lesson here, we're looking at the relationship between an accounts receivable ledger and then controlling accounts, and then also looking at how we record sales that are done on account using a sales journal. And so as we think through what we're going to be dealing with in terms of the subsidiary ledgers and controlling accounts, it's very similar to what we had going on with our accounts payable. When we have sales on account, for our business, we need to keep track of who owes us what money. And so we would have all kinds of subsidiary ledgers that track for us what businesses owe us a particular amount of money. And so we're going to be looking at how we create those accounts. Now, one thing we need to keep in mind is that as a business, when we're selling items, we are selling items for a profit, which means we are obtaining our items for a price and marking them up a certain amount and then selling them, and the difference between what we paid for them and what we sell for them has to cover all of our expenses, and it has to allow for our owners to get paid or for there to be profit within the business. So one of the things that we're going to be just thinking through here is that whatever we sell something for, that's the selling price, and whatever we add to what we paid for something to establish our selling price, we're going to call that markup. And then as we move through and think about when we sell to people, sometimes we sell and receive cash at the time of sale, and sometimes we sell and agree to receive money at a later date, and that's when we are going ahead and selling on account. So anytime we have something that's happening on account, we also have a subsidiary ledger or a sub-ledger that records all of the accounts for those customers that we allow to charge things. Now, we just want to make sure that regardless of when we're going to be receiving payment, the revenue is recorded when the sale is made. So we're always recording that revenue when we make the sale, not when we receive the cash payment back. All right, so here's just a little visual that shows for our accounts receivable ledger, we have all kinds of subsidiary ledgers that tell us that, say, Wells Apartment and Skinner College and Palmer Dentistry and Lake Automotive and Edmonds Hospital and Belk and Jensen, that they all owe us sums of money that add up to the total amount in our accounts receivable ledger. So that when we look at our general ledger for accounts receivable, we have the total of 10, 4, and 98 cents, but each of the individual subsidiary ledgers adds up to that total amount. Okay, now just remember that a debit increases our accounts receivable and a credit is going to decrease our accounts receivable. All right, so the subsidiary ledger form that we're looking at here, whenever we are recording information, we have the same column headings on our subsidiary ledger that we do in our accounts receivable ledger. So we have the account name and the account number, the date information, and the balance information. We do a check mark in terms of posting our reference, and then the account balance. So you can see that we have those same column headings going on, and it makes it pretty easy for us to track what's going on here. All right, so the second thing that we want to focus on in this chapter is sales tax. And we have sales tax in the state of Wisconsin. So every time you buy something in Wisconsin, businesses charge you, the customer, sales tax. And they charge customer sales tax, but the businesses don't keep that sales tax amount. They actually do have to go ahead and keep a record of all the sales tax that they collect for all of their transactions, and then they ultimately end up sending that money to the state. And so they need to keep an accurate record of how much they collect and then have to make timely payments to the state agency so that they don't get into trouble for not collecting sales tax. So a tax on sale of merchandise is called a sales tax. And we use a sales journal to record all of the sales that we have on account, okay? So we also are going to generate a sales invoice every time we sell something on account, because an invoice is like a bill when somebody else receives, and then they pay us according to the invoice. And in this example of the invoice, you can see we invoiced Wells Apartment, and the amount of the product we sold them totaled $454.50, and then the sales tax on that amount is $27.27. So we have to make sure that we record this information correctly. So you can see on November 4th, we sold our merchandise to Wells Apartments, the sales tax amount, the total due, and then it's invoice number 498. Now you can see that 3 different accounts are going to be impacted by this. Accounts receivable is going to be the total amount. And then we have an amount that's going to go towards sales, and we have a second amount that's going to go towards sales tax payable, so that we keep track of how much money we have to pay in sales tax. So you can see our sales journal here to Wells Apartment. We have those separate account headings: accounts receivable debit, sales credit, sales tax payable credit. All right, so we can go ahead and do an audit your understanding here. How are selling price and markup related? Again, you want to be thinking through, we're selling items to make a profit to stay in business. So markup is what we add to the cost of an item to reach the selling price. The relationship between accounts receivable ledger and the controlling account. We want to think about the total of all of the accounts in the subsidiary ledger equals the balance in the controlling account, and the controlling account is accounts receivable. What column on a general ledger form is not on the accounts receivable ledger form? And as we think through what's on the ledger form and what's on the accounts receivable, the general ledger account is the credit balance. That's not on the accounts receivable ledger. What is the title of the general ledger account that's used to summarize the total amount due from all charged customers? That's accounts receivable. And how are sales tax rates usually stated? Sales tax is always a percentage of sales. And in the state of Wisconsin, you're looking at 5.5%. Why is sales tax collected considered a liability? And in terms of liabilities, remember, those are responsibilities of a business to pay. It is a liability until we pay it to the government. So we collect it when we sell something, and we hold on to it until it's due with the government. All right, one thing that you would want to consider in terms of kind of a big idea question would be, what would happen if a business didn't collect sales tax? And what it might mean for a business if they decide not to allow people to purchase on account, and how those 2 different questions might impact business and business success. All right, so from here you want to go ahead and do the form questions and then proceed to do the work together and on your own. Good luck.